Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jon Ferro, along with Lisa Abramowicz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Jon Stoltzfus of Oppenheimer saying this: resilience is what's likely underpinning the economy's trajectory towards normalization. We believe the US economy is likely mid-cycle rather than late cycle, as some suggest. Jon is with us for more. Jon, good morning, sir.
Good morning, John.
Another all-time high in the equity market. And I just want to frame your views coming into 24 because I think it's important to sing your praises because you are a modest man and won't do it yourself. You came into this year and you said, I'm constructive risk, I'm long the equity market, but it's not dependent on this Federal Reserve cutting interest rates. I don't think they will anytime soon. What did you see that was like your guiding light around the story so far this year?
I think what it really was when we look back at it, John, is the thought that Jerome Powell does not want to be remembered for blowing it on inflation and letting inflation come back in after cutting. And I think the Fed mostly feels that way when you hear the differences in the Fed speak. The mix were some not expecting any cuts, others expecting 1, 2, whatever it be. Those of us who lived through the 70s inflation never forgot it. And the failure of Arthur Burns and what necessitated draconian measures by Paul Volcker. And then a 15-year period, as I recall, of Alan Greenspan and a science project learning what the modern Fed would be like in terms of where rates would go. I think that memory is very much in Jerome Powell's mind.
Calling what the Fed will do is tough. Yep. Calling how the market will respond to it is sometimes even harder. You got step one right. You got step two right as well. Let's talk about step two. Why did you believe that wouldn't be negative for equity markets?
Well, I very much remember when the 10-year was at around 9%, and I remember a Fed funds rate that was significantly higher, and I remember equities moving up. It was after I came into the market in 1983, so that was Volcker's second term. And I might have made a mistake. It may have been that the Fed funds rate was 9%. I don't quite recall. It's published in our pieces every week, but I can't remember everything. But what I will say is it depends if business can still grow revenues, if they can still grow earnings, and if there's enough innovation around, things are changing for the positive. Business people will move on that, and the market will get a sense as a discount mechanism that stocks can move higher. I remember speaking with clients when they were enamored by 12% coupons on fixed income, and I was pitching equities. Okay, for diversification purposes, we could have a little bit of both. But the equities were just screaming out that they were undervalued relative to where we were headed.
Are they still screaming that out? I mean, we're pretty close to your year-end target.
I don't think they're quite screaming it out. I think equities are closer near-term to being fully valued. But I think that our 5,500 target is likely to be exceeded probably in the next few days if we don't get some catalyst for the bears to move in and take us down 5 or 6% as they've done so frequently this year.
Some people have argued that this is a fragile rally. This is the 28th record high as of yesterday. We're still counting. But it wasn't led by small caps. It wasn't led by sort of a broadening out at all. It was led by big tech. In particular, it was led by NVIDIA, by Apple, which became the most valuable U.S. company out there, surpassing Microsoft once more. So do you view this as potentially a negative sign, that equal weight just keeps underperforming even though the tailwind ostensibly was the potential for rate cuts?
Well, I've got to say the thing about the big tech companies is that they're profitable, they've got a positive cash flow, and they're deeply embedded in our lives. Oppenheimer doesn't allow me to talk about individual companies because I manage money, but I can say, I can
AI chips.
and AI chips are essential to to where we're headed, and businesses are looking to invest in AI because they want to remain competitive, they want to be more efficient, and they want to be able to navigate tougher environments. If anything, today, people over the last 15, 16 years have been some of the toughest times. You know, the great financial crisis, the pandemic, the whole mess with the global supply chain, a move towards diversifying away from one country's centricity, dependency on the global supply chain, all this stuff. And it requires advanced logistics, all kinds of technology to navigate this. So, you know, the other side of it is, but I can say there's one company that we all know very well. If we brought out our cell phones, probably all the cell phones would be by that company. What did they do? They set it up so if you want the latest in AI, you have, if you don't have the phone that came out this year,
buy a new one.
Phone, you gotta. We're all tied to an upgrade cycle, whether we like it or not, irregardless of who's supplying our technology. And that makes tech very important, and not in an artificial sense, because it's both business and the consumer find it deeply embedded in their lives.
So you're bullish, Jensen, and bullish, Tim. I'll say that for you. You're overall constructive on this equity market. Now, I understand why. It's fairly convincing. We had an upside surprise on payrolls. We had a downside surprise on CPI, and a Fed willing to cut interest rates at a first sign of weakness. Sounds pretty constructive. My favorite question for you, what would change your mind? What would you need to see that would lead you to come on this program and say, John, changed my mind, don't see it the same way, trim some risk?
It's what Barton Biggs would have called the bolt from the blue, the sock to the jaw, you know, the unexpected problem that emerges that would cause people, like in 2022, when everybody just projected negatively overnight, not us, but it could sour sentiment near term or something really dramatically awful. But otherwise, where we're headed just looks like there are more positives to offset the challenges and the negatives that appear.
Yeah, well, we're not even halfway through the year, and we're, you know, basically a stone's throw from your year-end target. So barring some sort of cataclysmic event, how close are you to upgrading your year-end target?
Oh, I would say very close, but it's our discipline happens to be that unless the S&P closes at or above our target, we don't raise it, because we don't want to jerk the clients around. You know, there's a lot of people will just, they'll upgrade and downgrade, and they'll give two different targets and everything. We're pretty disciplined on our targets, and fortunate that we've been fairly successple with them over the years.
You stay disciplined, John. It's great to see you. And you've had a fantastic year so far, and you've been working very hard. We appreciate it.
Knocking on whatever this substance is.
I believe there's a little bit of wood in there, buddy.
So knocking on wood.
Hopefully there is.
Okay.
Jon Stoltzfus of Oppenheimer. John, thank you. Introduce Subadra Rajappa of Societe alongside Jonathan Pingle of UBS. So we have team no cuts in 24 alongside team December now, because we had a changeover at UBS just yesterday. I want to come to Societe first. Subadra, let's talk about this data. What does this data tell you? And put it together with what you heard from the Federal Reserve Chairman yesterday and sort of square that circle for us.
This is, of course, one data point. The fact that the claims number went up is something to keep an eye on, because typically when you tend to see a deterioration in the employment picture, you tend to see that led by initial jobless claims. It tends to be a leading indicator. But that said, again, one data point doesn't make a trend. We'll be looking to see what happens. What was interesting to me in yesterday's summary of economic projections is the fact that the Fed kept core PCE at 2.8% for this year. So they're expecting about roughly 0.2 increases month over month for the remainder of the year in core PCE. So in that sort of context where inflation is still relatively sticky and the job market is quite strong and growth is in the context of 2 to 2.5%, I don't see any need for the Fed to rush in to cut rates.
I want to couple your inflation outlook with their outlook for unemployment. They see it staying exactly where it is right now, at 4%, year-end 2024. Jonathan, how are you thinking about the incoming information stacked up against what they're projecting for the rest of this year?
Well, that was actually a big reason we went from Team September to Team December. I mean, we were actually forecasting an increase in initial jobless claims today to 235. We were expecting an increase in continuing claims, and we were expecting a downside surprise on PPI, and we were actually one of the few shops expecting a 0.2 on core CPI yesterday. We have been watching the data slow and think there's a slowdown underway, but we got an FOMC that really just seems to think growth's fine, and not just fine, but great. I mean, they didn't even mark down their assessments of the pace of the expansion in the first paragraph of their statement, which is typically where an FOMC would acknowledge some moderation. But they seem extremely comfortable with the current stance of policy. They feel like, the labor market is still healthy. I mean, I will agree that is one place where if it does roll over rather quickly, they might respond. But it really looked to us like an FOMC that seems very comfortable waiting and without a lot of urgency to start dialing back restrictiveness.
Subadra is sitting here thinking, all right, everybody just keep coming to my way, because I've been saying this for quite a while, or no cuts at all this year. Are we asking the wrong question? Are we basically asking when are they going to start the rate cutting cycle, and not what the rate cutting cycle is going to look like if they wait longer? In other words, if they do not cut this year, Subadra, are they going to have to cut much more deeply next year in the face of that weakness that Jonathan was talking about and a lot of people are projecting?
I think I would prefer that than being in the situation that the ECB is in, where they've said they cut rates, and then now it's uncertain if they're going to cut in July. It doesn't look likely that they'll cut they might cut in September. But then after that, they're looking at unit labor costs going up. They're looking at other factors that's going to keep them on hold. I don't see the need for the Fed to cut. I don't see the need for any sort of insurance cuts. Why should they cut and then wait for 6 months to deliver the next cut? Why not just wait for the data to corroborate a need for cuts and then go on some sort of a methodical fashion, or maybe once a meeting or once a quarter when, to ease policy? I just don't see kind of the rush for that first rate cut.
Jonathan, would you agree with that? Are you sympathetic to the view that some have espoused, including Neil Dutta over at Renmac, talking about how this is a rapidly weakening economy, and if the Fed doesn't get ahead of it, that the declines are going to be harder to counter in the future?
I mean, if I were a monetary policymaker, I would probably thinking about some calibration might be needed to ward off worst case outcomes. I think one of the problems is that we're seeing slowing in growth, but we're not really seeing such severe slowing that monetary policymakers seem like they really need to act urgently. But, we have that. That's our expectation, is that growth is going to slow. It's going to take the FOMC time to digest. But next year, they're probably going to want to pick up the pace a little bit, right? I mean, so we have them after they see payroll slow, after they see GDP growth slow, we've got a little bit lower inflation forecast than they do, that they're going to start to feel like, look, maybe policy really is restrictive, something they've been debating a little bit. Maybe we need to get out of this restrictive stance of policy a little bit more quickly than we expect. So we expect them to have the same terminal rate that they have in the SEP, but get there a lot faster next year and into 2026 than their current projections.
John, I don't want this to turn into a therapy session for Wall Street, but I just imagine it must be incredibly frustrating for you to have absolutely nailed the data of the last 24 hours and then been surprised with the way they've responded to it. What are you struggling with right now? Their reaction function, or just the way they're seeing the data that you've been forecasting? What is it?
I've been a little surprised at their sort of lack of acknowledgement over the degree of cooling, I think, that's underway. I mean, non-farm payroll employment looks good, is certainly a headline, and they've sort of walked away with that as sort of a summary statistic for the strength. But even if we look at non-farm payroll employment, I mean, private employment over the last 12 months has slowed to sort of 178.
Can I jump in? You say they walk away with that. And I walked away from the news conference yesterday and I heard Chairman Powell say something like maybe 272 overstates the strength of the labour market. I just wonder who they is on the committee right now. I find it really confusing. 272 for some seems like it's the real deal, hence the dot plot. It's another part of the dot plot that feels like they're in Camp Powell. Maybe it overstates strength. When you say things like they, who are we even talking about in the committee anymore?
I would actually, in terms of this narrative, I'd lump in the vast majority of participants. I think when I hear Governor Waller talk about the strength, think about Philip Jefferson's speech before the quiet period, talking about the strength in private domestic final purchases. I mean, they're all pulling out relatively strong components and cuts of the data at the moment, and I feel like you got an element of that in Chair Powell. Even though he might acknowledge that the 272 was overstating, he's not acting as though it's 190.
Mike, what was your take?
I think that at this point, they don't know what they're doing. And so they're going to be honest about that. The difference between Subadra and John is that you guys have a forecast, and you make a forecast, and they have 19 forecasts. And we for our convenience, pick out a median and say that's their forecast. It's not their forecast. There's 19 different forecasts, and the range is pretty wide, and especially if you look at 2025. The range is very wide. There's a plurality in the middle, but they don't know what's going to be happening by then. So, and another quarter from now, in September, they'll change their forecasts and their dot plot again, and we'll all recalibrate. I think basically they're in a sort of hold mode, risk management mode, I guess, at this point. We'll see where inflation goes, and we can move, but we don't have to.
You know, John, you didn't want a therapy session. I think that actually
We're
right
about
now,
to get one.
a lot of people are looking for a therapy session because there was a lot of uncertainty, and it's been a very challenging year. So, Subadra, I'm curious how you come up with a projection of there is enough strength. We don't need those sort of cuts to sort of be cosmetic or get ahead of that weakness. What gives you conviction in that? What's your guiding compass at a time of such great uncertainty?
You can listen to the Fed. For instance, when you listen to John Williams from the New York Fed president, what he said was his expectation is for growth in the context of 2 to 2.5%. He's expecting the unemployment rate to be around 4%. And he's expecting core PCE above or at or above 2.5%. So even from what they're saying, just from their own forecast and the summary of economic projections, leave alone our forecasts and our expectations, there's no clear indication that they're going to need to rush into cuts. That's why I think that, in addition to our own forecast from our economists, what we're hearing from the Fed is also consistent with the Fed that needs to be on hold for the remainder of the year.
Honestly, I got to say, John, one thing that people, Jonathan Pingle, one thing that people keep saying is all of this out there, it sounds bad, it's hard to gauge, whatever, but NVIDIA is going to change the world. We're going to have all these technological advancements. We're going to have fiscal impulses that come down the pike. How do you factor in sort of the nebulous concepts that have driven this market this year, as opposed to sort of overarching macro top-down views?
So we could get an NVIDIA boost. I would say if that really was a productivity boost, we would see lower inflation, and the Fed should probably have lower rates as well. And the fiscal policy obviously has been huge. I mean, it's really done a lot to insulate the economy from the rate hikes and the rapid rate hiking cycle of Fed. And that is an impulse that's fading right now, and we're going to head into 2025 with a year Congress is probably going to spend having to rewrite a substantial amount of the tax code to avoid the fiscal drag at the end of the year. So these are all meaningful influences. I mean, we all just have to sort of do our best, look at the details, aggregate up. But I mean, I would sort of echo this point. It's not necessarily that we can debate how we're thinking about our growth forecast, but if we take the wide swath of FOMC participants, they just don't seem to be internalizing any trade-off between growth and the level of interest rates right now. And that just seems to be a group that is willing to wait. And the other reason we pushed out our call is just, when they get into September, if they're still not facing a trade-off with weaker growth, I think the arguments will carry the day to wait longer.
I have to wonder, Subadra, August 22nd, August 23rd, I think it's August 23rd that Jay Powell is going to be in the Tetons, and he's going to be talking to people, giving a message. At one point, it was a very clear message. Pain. It's all going to be pain. We need to get this under control. What's it going to be this year?
I think it's staying the course. I think it's caution. For the most part, the Fed is going to strike a cautious tone. In my view, at least, I felt like they pivoted too soon towards rate cuts late last year, and I think that they're going to take a much more cautious tone and wait for the data to guide them on policy. So our expectation is that they'll start cutting sometime in the first quarter of next year, and then deliver a steady set of cuts for the remainder of the year. But then the terminal Fed funds rate is probably going to be higher. We think that the R-star is also higher, and you're seeing that in the market pricing for both the Fed as well as for the 10-year yield, which is higher for longer. So the market is ever so slowly calibrating to a much higher R-star. And so I think that the Fed is going to be somewhat cautious. This feels like a little bit of a paradigm shift, if you will, from the period after the great financial crisis when we were bringing down the R-star ever so gradually. Now we're going to go the other way and start recalibrating R-star higher.
Just perfectly said. It feels like post-GFC. In reverse at the moment, that's for sure. A special thanks to Team 2025 and Team December, Subadra Rajappa and Jonathan Pingle. Thank you. Terry Haines of Pangaea Policy joins us now for more. Terry, let's do the side by side, the preview. How different are those two addresses going to be?
Well, of course, they're pretty different because one's primarily about domestic policy and one's about foreign policy. I mean, Biden will be doing what he's doing with the G7, talking about Russian assets and how to deploy them to help Ukraine, as you and Lisa were talking about a few minutes ago. And what Trump's doing in Washington today, frankly, is fundamentally he's making a pitch to business leaders and trying to show unity with congressional Republicans to show what a 2025 all-Republican Washington might look like. Now, I think that's only about a 30% likelihood at most. The split Congress is a split Congress, and with a tiny Biden advantage is my call today. But even if Trump's president, markets should understand that what brought on the animal spirits in 2016 wasn't Trump being president. It was Congress going all Republican that allowed the 2017 tax cuts to happen. So, the Congress, frankly, here for what markets care about is more important than the president, and that's kind of what Trump's trying to show.
Terry, let's just sit on the business roundtable. We're not talking about any CEO. We're talking about the CEOs of the biggest financial institutions on Wall Street, the CEO of Apple. There has been a question more recently over the last few months, particularly on this program, about how business-friendly a second Trump presidency would actually be. How business-friendly do you think it will be?
They'll try to make it so, and I think it probably would be should it come to pass. Although, as I say, it's not my base case. With a Republican Congress, I think what you get is if you get an all-Republican Congress, just as in 2017, you see the Congress driving things like tax cuts and the policies that business cares most about. They were much more in the driver's seat than Trump was on that sort of thing. I do think that if you see a Trump presidency with a split Congress, though, you're going to see a lot more of what I've been calling recently Mount Trump, where he pushes back against those who don't want to do whatever it is that he wants to do in the Congress. Now, that relates mostly to, I think, fiscal policy and domestic policy. Let's remember that in today's Washington, just as in 2025's Washington, you're going to have an awful lot of unity on foreign policy, all to the good, and you're going to have an awful lot of unity on fiscal policy that, frankly, makes markets feel squirrely because it's more fiscal spend, more debt and deficit.
There's a lot that you said there that I want to unpack, but Terry, this idea that we might hear what a second term of President Trump might look like, what are you listening for, especially when it comes to the business world at a time when a lot of people really don't have certainty around that?
Well, it's a pitch. He's here for a lot of reasons. And just as any politician, you're trying to not only show what you do think, but you're trying to show what kind of reality you'd like to create. He's in the business of showing a couple of things. One, that he's business friendly, and secondly, that he's going to be a kind of a rational actor on a lot of this stuff. And he was on tax cuts. And one of the things that he wants to do is remind people that they'll continue to be a business. He'll be a business friendly presidency, that he wants them to, and they should want to support Republican candidates in Congress to create that all-Republican reality that allows them more business freedom, less taxes, less regulation, that sort of thing. And he also wants to show, frankly, that he's worthy of being supported financially and rhetorically and every other way, because the reality, again, is he doesn't have a united party and he's not attracting independents. One way to do it is to show he's clearly differentiated on economics.
Terry, you said that there also seems to be some unanimity on foreign policy at a time where President Biden is at the G7 trying to sort of immunize international policy from elections, given some of the latest moves on Ukraine. How do you square that? What does the united front in the U.S. look like when it comes to foreign policy and what's likely to come down the pike, regardless of who takes office, but maybe with a greater emphasis with another President Trump?
Well, you're going to have a situation where in 2025, regardless of who the president is, where the vast majority in Congress, and I think the vast majority of the public too, supports current U.S. foreign policy, supports helping Ukraine, supports helping in the Middle East, helping Israel, and getting peace there, helping in the Indo-Pacific, all the rest. One of the things that took so long in getting that aid, though, frankly, is that Biden was not very good, very forceful, pushing very hard to actually get that. It said everything that Biden announced this emergency in November, and yet no one, Democrat or Republican, on the Hill really reacted to it, and it took almost 6 months to clear it up. I suspect what you're going to end up seeing is a lot more urgency down the line. And I think just as last time, Trump largely gets led by Republicans in Congress to create a foreign policy and an economic policy that continues along the same lines. You may see a little skepticism on the margins, but right now I don't think it's going to be that significant.
Hey, Terry. Good to catch up, sir. Terry Haines of Pangaea Policy down in Washington on the latest.
This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.